really exciting to be doing this for the first time. I don't think we have ever done anything quite like this for our clients before. Have we, Becca? I think this is probably the first time.
No, I don't think so.
Anyway, so are you recording? Are you going to record this?
Already am.
Okay, perfect. I just wasn't sure. Okay, welcome everybody. Looks like we have a full house. This is terrific. So I see that in addition to our higher landing clients and some Grizzlies, we also have some other guests with us. So welcome to you as well. So I would really like to introduce you to this, this super important and timely webinar that should be to anybody from the energy sector, whether you are employed or in transition. And, you know, because so many of our clients' lives and careers are in the midst of this unprecedented disruption, primarily due to the alarming shift within Alberta's energy sector. As a career management and outplacement company, I really feel that it's extremely important for higher landing to be able to pass on to you the most current, timely, and objective information as possible so that you can be equipped with the information and resources you need to yeah, mute, thank you very much. So that you guys can make the most, I guess, informed and potentially, I mean, we're talking life-changing decisions when it comes to your future careers. And I think this is especially timely as we move into 2021. So as you know, I've talked about this numerous times, we're in the midst of this, probably one of the world's largest societal and workforce shifts in history. And it's impacting our resource sector probably at the fastest pace ever on record. So what this means for people who work in the sector is that there is no going back, you guys, there's only going forward. So as job growth in the energy sector slows, what does that mean for you? What does that look like? And we really owe it to ourselves to answer some of these burning questions and become as informed as possible about what's happening with this whole new reality of work that we're in, both in Alberta as well as out of the province, so that we can find the answers to all the uncertainty that's looming in our professional careers. So that's why I have invited Rory Johnston to offer his independent, you guys, independent perspective on Alberta's oil company and how this, how he sees this is going to impact Alberta's future job market. And I think the timing of this couldn't be better, especially when we've just gone through probably more than 2 years of digital transformation in less than 2 months when the pandemic started. And this massive disruption is still unfolding and impacting the lives of thousands of you, thousands of Albertans, thousands of your family members, whose livelihoods have depended on the oil and gas industry for decades. So I'm really excited to have Rory come and speak to us today. I'd also like to thank him for taking his valuable time to come out. Rory is an analyst with experience in macroeconomics, commodity markets, and policy. He is Price Street's, it's a company in Toronto, a managing director and market economist, and he publishes commentary, communicates his firm's views on market developments to clients, as well as the media on a regular basis. So prior to Price Street, Rory was a commodity and international economist at Scotiabank, where he was developing models and economic forecasts. He was harmonizing outlooks across business lines. He would advise the bank's credit committees on sector-specific risks, and he also relayed Scotiabank's view to external audiences. So he also holds a Master of Global Affairs degree from the University of Toronto's Monk School of Global Affairs and Public Policy, as well as a bachelor's degree in political studies from Queen's. And he is a very highly sought after subject matter expert on Canadian commodity issues, particularly as they pertain to the oil and gas sector, which I thought was why it was so relevant and timely for him to come and speak to us today. He's also a regular guest speaker on news sources such as CBC, BNN Bloomberg, Yahoo Finance, and there's a ton of others. So I've asked Rory to provide his independent perspective on the state of Alberta's energy economy and the future for laid off oil and gas workers, or those that are in transition or about to be in transition. So he's also going to talk to you about some of the emerging sectors of the Canadian economy, where to watch for future investment and commensurate job growth to occur. I think that's also really important. So he's going to start with a presentation and then open it up for Q&A. And as he's presenting, you guys, please feel free to record your questions in the chat. And we will take probably a combination of your questions both via chat. We might read them as well as invite you to speak if you're interested. So on that note, I am really excited to welcome you to Rory Johnston. Hi, Rory.
Hi, Jackie. Thanks so much for having me. Hopefully I can live up to that introduction from Jackie. But just to give you kind of a bit of background, so as Jackie was saying, I'm currently at a company called Price Street, where I work on modeling and economics and all of that fun stuff. But over the last kind of half decade, most of my time has been spent watching OPEC and the oil sands industry and oil prices and everything in between. So half of my job was coming up with the views, and then I would say really even more than half my job was communicating, explaining those views, explaining how all of this stuff interacts. That many of you will very well have a kind of an intimate understanding of many facets of this oil sector, particularly the oil sands sector broadly, which is very, very different from oil sectors globally. But a lot of Canada doesn't understand that, and that's also kind of helped feed some of the misunderstandings of what the sector is and what it needs. So I'm just going to kind of turn to a presentation I put together here. Let me just see here. Can everyone see that? I'm just going to pull this up on full screen here. So what I'm going to do is I'm going to kind of walk you guys through a presentation that's very similar to one I actually gave to OPEC in Vienna in November, just before I left Scotiabank. We were briefing the Secretariat, so the group of ministers and their advisors, on the global oil markets, and many of them had really no idea what the Canadian oil sector looked like, how it worked, how vastly different it was from the oil fields in Saudi Arabia. So a lot of these graphics I put together for that purpose, and I've updated them to kind of show how COVID and how our current market experience is kind of impacting that. So I'm going to take you through a little bit of just an update on what's happening in the world, how policymakers are trying to alleviate some of these strains on the global economy, and then turn to the oil market globally, down to Alberta, and then I'm going to kind of finish with talking about how the oil industry has driven Canadian jobs growth and wage growth, and also how in the future that will be, whilst the oil sector will still be a very important component of the Canadian economy overall, a very, very large component, it likely will not make up the same kind of growth in the economy and jobs and wages that it once did. So I've titled my presentation here, Oil Markets and the Oil Sands in the COVID Age and Beyond. So just a bit of an update here on essentially, I'm just going to move my little slide over here. There we are. So what we have here are, I'm sure many of you have seen some of these graphics before, but what we have are the mobility trend tracking from Google and Apple. And as you see, obviously, and as everyone here has experienced, come early through this year, end of February, beginning of March, the entire global economy essentially froze. It was an unprecedented shock to the global markets. It had a whole bunch of knock-on effects that no one had really seen. We've seen unprecedented intervention from central banks, unprecedented fiscal rescues, and an unprecedented fall off in global activity. Really, comparing it even to a depression is, I think, a misnomer, because we've never had an event like this that kind of froze everything all at once in the global economy. But what we see now is, what does this really do for the future? This is going to be fundamentally a transient event. It's, even if it takes 2 years, which I think is probably a fairly safe bet at this stage. I'm personally kind of aiming at the end of 2021 for getting back on an airplane myself is my current forecast, but hopefully I'm proven wrong there. But this is going to be temporary, but the question is, what does this do for the oil market on a long-term basis, the global economy on a long-term basis? I think what it fundamentally does is it, one, changes the fundamental relationship between national economies and their governments. I think governments are going to have to are already playing an unprecedentedly large role in this economy. And they are playing, and they will be playing an unprecedentedly large role going forward, that there just really isn't the private sector demand when everyone is essentially, if not locked in their houses, not able to go to movie theaters and on airplanes and concerts and everything else. So, there's a big hole in that demand, and the government at this stage is filling that. One thing you will note here as well is that we had a rapid fall, kind of a rapid climb back, and then I think right now the global economy is kind of turning over again. We're slowing down again. Either the second or third wave of COVID is scaring people, and we're starting to see lockdowns of the economy again, sporadically, but I think that those will likely accelerate into the end of the year, just because that's the only thing we've figured out so far that can stop the hospitals from being overwhelmed. It's a very blunt tool, and I hope that we will find something better, but at this stage, it seems to be the only reliable metric. Now, what does this mean for oil, right? So when you look at, when this was all starting to go down, it was fascinating to see exactly what happened and where. What's interesting, if you look here, so this is a breakdown of oil demand in the United States, and it is, there we go, sorry. So oil demand in the United States is relative to where it should be for this time of the year, all else equal. And what we saw was, as I was saying at the end, the beginning of March, everything more or less fell off a cliff. Jet fuel was the most impacted, falling 75+%. Gasoline was the next most impacted. I remember seeing, at the corner gas station, I remember seeing gasoline for 60 cents a liter, which was, I couldn't remember even from when I was a kid. These were like ridiculously low prices. And what essentially, everyone stayed home. You didn't see as much of a fall off in diesel demand. And in some cases, you actually saw odd spikes in diesel demand consumption as people stopped going to the stores themselves and got everything delivered by Amazon. So you had the highways around Toronto, where I live, were fairly sparse in terms of cars. But they were packed with 18-wheelers and transport trucks. Logistics, shipping, all of this has become a very large part. And as you see near the end of this slide, you do have diesel demand is more or less back to normal. Gasoline demand is pretty close. Jet fuel and the global demand mix, depending on where you're, how you're figuring, it's between 7-9 million barrels a day. So maybe about 10% ish of the global demand mix. But that's probably going to be at 50% or less for the next couple of years. And I think that's where the long-term kind of holdback on demand will be. Now, if we look at oil prices. So the main thing I want to do here through this presentation is not necessarily give you a forecast of the future. I'm no longer paid to give forecasts of the future. I think that anyone that says they fully know how the future is going to turn out with the kind of confidence that we are often asked to provide is a misnomer. And I think that's particularly true in moments like this of massive kind of radical uncertainty. Of unprecedented events. So what I'm hoping to do here is more kind of to give you a sense of the data that's available, the trends that we're seeing, and how I view the global economy, the global oil industry, and the kind of the Alberta oil industry, so that you can then be empowered to make your own choices and your own inferences from what you see in the headlines, what you see policymakers doing, and everything in between. So on this chart, what we see is you have your oil prices in the middle, Brent, WTI, and WCS. WCS is the Canadian main export blend. I'm sure almost all of you are very well acquainted with this benchmark. But the interesting thing here are two things. One, WCS is a heavy oil sour benchmark. So it means it's slightly harder to refine, slightly more sulfur. So it typically trades at a slightly lower discount, call it $8 to $10 a barrel below WTI in any given day, on any given day. Then you also have the transportation, and this is where, rewind even 6, 7, 8 months ago, the number one concern for the Alberta oil patch was egress, was pipeline bottlenecks, was the lack of availability of rail, was the inability of the sector to get their products to market. Now that hit its kind of most acute moment at the end of 2018. $15 a barrel to 50. So that was the first time in a while where people really kind of backed up. Now, these types of bottlenecks did occur back in 2012, 2013 as well, but they were less acute and they were generally shorter lived. This time around as again, if you're aware, this prompted then at the time the Notley provincial government to impose a curtailment on the sector to try and prevent the kind of collective action problem that was kind of hitting the sector, that was devaluing all of the sector's barrels. If you cut back by even a couple 100,000 barrels, you could essentially raise the value of the millions that remain. So this is exactly what we saw. But now fast forward, and egress doesn't all of a sudden seem like the biggest concern anymore. In fact, we actually currently have in Western Canada a bit of a surplus pipeline availability to the production that's currently in the system. But that's something I'll return to at the end when I go back to the kind of the Alberta level. Again, on here, I just want you to kind of look at two things. At the top chart is a reflection of the tightness in the market right now, and that's what we'll call the kind of front month contract of WTI, and its difference to prices further down the forward curve. When we're in backwardation, which means the prices today are higher than in the future, we have very, very tight conditions, which is actually more or less where we were just before the oil demand fell out completely with COVID. If we see just before the, I don't know if you guys can see my cursor here, but just about here, you had, backwardation, and that was meant, oil markets were tight. Things were actually starting to recover. And then just at that moment, the entire global economy shut down and people stopped traveling. So what that did essentially was backed up a huge amount of oil. It was the same thing that essentially happened to the Alberta patch in 2018, that you had all of this oil and nowhere to put it, but it was happening at a global scale. And instead of a couple 100,000 barrels a day of overage that you needed to find homes for of distressed barrels, we're talking 10, 15 million barrels a day, 15% of global production. It's basically if you combined Canada and Saudi Arabia, that entire volume of daily production had nowhere to go. So unsurprisingly, prices collapsed, at a magnificently kind of rapid pace. And this entire descent downwards culminated in around April 20th of this year, when WTI actually, for the first time in history, actually traded for negative prices. It was an odd event. There was a lot of technical factors that were going on that caused it. But at its basis, it was a reflection of just how tight, just how uncertain things were, that you could get to a level where theoretically the most valuable commodity market in the world traded at upwards of $30, $40 negative per barrel. Now on the bottom chart, I also want to show you that people often talk about speculation in oil markets, and how that can drive them up or drive them down. I do think that you do have some impact there, but I typically view it as a bit of a counter indicator. So when this red line is high relative to where it was recently, I actually think that means that you actually have more speculative activity in the market, which is actually supporting prices where they are right now. So unfortunately, if you look at this, what this is telling me is that we actually have relatively high speculative kind of positive bullish activity in the market. So all else equal, if nothing else changed in the market and we just had a renormalization of kind of speculative balances, that you would essentially have a bit of a sell-off in oil markets. Just one moment, actually. My headphones have been acting up, but I'm just going to switch momentarily to the other system here.
Hi, Rory. I don't think we can hear you. Oh, we can hear you now.
Hi. Is that still working for now?
Yeah, we can hear you. Thank you.
Okay, thank you so much. So I'm just going to go back here and just reopen this. I apologize, but my headphones had a bit of a tumble last night just before this event. So I'm going to try and work with what we've got here and juggle between them. So if we kind of look from the overall price of the commodity and then kind of drill down a level more and look at the value of the companies that are producing that oil, you can essentially see that the overall equity markets tumbled tremendously through the crisis. You had the sharpest sell-off since the Great Depression, but things bounced back pretty quickly for virtually all companies. The one unfortunate exception here is the oil sector, which both fell much faster than the rest of the kind of companies in the indices, but also remained depressed and essentially continued to trade down. If you look at the chart on the right here, the best performing energy sector stocks in the S&P 500 are performing worse than the median, let alone the average of virtually every other sector in the index. We had the energy sector used to account for, even at the beginning of Obama's term, it accounted for something like 11, 12% of the S&P's overall market capitalization. And now we've seen that cascade down to it's around 1 or 2 now. So you've seen a massive erosion of value in these markets, of these equities. And I think a lot of the things that you'll be hearing and seeing about layoffs and cost cutting are primarily reflections of this, not just the fact that the oil markets are uncertain and things are hard fundamentally on the business side, but also capital markets have very much turned against the sector. It's no longer currently seen as a responsible steward of capital. These companies have embarked on very, very large growth projects instead of focusing on the profitability of the barrels they produce. But this is actually one of those areas where I actually think that the Canadian sector, that because we've been in this this backward crouch of a lack of pipeline capacity for so long now, I think the sector has already started to shift gradually away from a growth mindset towards one of cost cutting, stability, and kind of profitability per barrel. So I actually think the Canadian sector has a bit of an optimistic head start on this factor. But I do think that what we're going to see there is, but I do think that the good news for the kind of market value and the kind of continued viability of the sector in Canada is unfortunately going to not be a great story for labor markets, because the only way that the Canadian sector is going to be able to continue to cut costs, continue to be competitive, is increased automation, decreased labor, a decreased labor force. These are the areas that are unfortunately going to take the initial brunt of that cost cutting. Now, amidst all of this, we've seen a couple things. Governments and central banks have really thrown everything they've had at this. Central banks, if we just actually jump forward here, the largest kind of injection of money from central banks in an extraordinarily long time as a proportion of the economy, probably actually the largest ever. At its peak, we were talking about something like, almost $1 trillion a week of kind of combined between the Fed, the ECB, the Bank of Japan, and the Bank of Canada, all kind of flooding into the markets. Interest rates were already low, which is what we see here. Interest rates collapsed. Central banks cut interest rates, tried to stimulate the economy. When that didn't prove enough, they dumped even more money into quantitative easing and other asset purchases that lowered rates for businesses and theoretically trickled down to consumers. But in many cases, it's no longer seen as broadly, it's no longer seen as the main kind of way forward is for central banks to continue this. We're starting to see a transfer of at least rhetorical responsibility from central banks, which has kind of always held that firefighter role, back to governments and fiscal managers People are demanding much larger packages, support packages for the economy in the United States. We've seen the CARES Act. In Canada, obviously, we've seen a whole suite of programs between Canadian emergency wage support, the Canadian emergency recovery benefit, all of these things, essentially attempted to plug that demand hole. And in many cases, the crisis that we've seen thus far has been very, very muted relative to where it would have been absent those programs. Because at the end of the day, people still had money. Even if they didn't have work, even if they didn't have kind of a place to go in the day, they still were receiving money either from their employer, or their employer receiving money from the government to keep them on the payroll, or they're receiving CERB or something comparable on the unemployment side. That allowed enough money to stay in the economy that people could still, even if they couldn't go to a restaurant, they could still order takeout. Even if you weren't going to the movies, you could still pay for some kind of entertainment at home. And because of that backdrop, that government support, the economy has been relatively buoyant, for where we would have been otherwise. And when I say relatively buoyant, in the context of many global economies have been shrinking by, 10% or more in the first half of the year. So absolutely catastrophic, hit to the global economy. But governments so far have been stepping in. I think there's going to continue to be pressure there. As this applies to oil and Alberta and kind of everything in between, it's important to think that if the market is no longer the primary driver of investment or kind of spending in this recovery period, if the government is going to play a relatively larger role, you're going to see things like, we've heard Ottawa talking about the green recovery. We've seen other kind of forces that, people are saying that this is essentially the opportunity to reorganize the economy along something that's more sustainable, that's less carbon intensive, that if the government is going to have to spend all this money anyways. People had been complaining that something like the Green New Deal was going to be, horribly, catastrophically too expensive. And that argument looks less it holds less weight now that essentially every government program globally looks historically catastrophically too expensive. So if we're going to be spending this money anyways, I think there's going to be a lot of pressure to focus on, jobs of tomorrow, economies of tomorrow, whether or not that's, in Alberta, you're hearing about, bitumen beyond combustion and some kind of, petrochemical or plastics focus for bitumen production instead of being transformed into, WCS barrels. You're seeing discussions of hydrogen and other forms of, if not straight, if not, purely renewable, whether it's extracted from, natural gas seams or whatever. These are, we're talking about what comes next for sectors that can't be electrified in the way that vehicles or, home heating or your stove can be. What about things like steel production and other industrial processes that use hydrocarbons for high intensive heat? Those types of things is where hydrogen is going to be useful. And I think there's, if we're going to be spending this money, might as well try and spend it towards these other types of potential job boosters in the future. As in all things technology, as in all things renewables, it's never, you never know what's going to work. When I first got interested in energy, hydrogen was all the rave, and then it went through, an 8-10 year kind of, wandering through the desert and no one paying that much attention to it. And now it's back in vogue in the last year and a half or so. So these things change quickly. And I think with that in mind, it's hard to kind of peg it, investments in the right place if you're trying to choose the next technology. But I think there's going to be a focus on just kind of funding a bunch of stuff and seeing what sticks. Kind of going right back to the oil industry and how this all kind of comes back together. If we see here, we've got supply and demand. This is your kind of general supply demand balance of the global oil market. This is kind of where I typically start an analysis. And things were, you had a period of oversupply here, you had a period of oversupply here, and you had all these inventories that had built up. This was really the crisis, the crash that pushed global oil markets to first collapse in 2014 when shale was coming up and OPEC was trying to defend market share, and all of that initially started this, call it, call them the hard times essentially for Alberta at the end of 2014. This is really what started, is with this gigantic hump of roughly 1 billion barrels or so of oil that had been built up over that period. Now what you see is that period of relatively large sustained surplus in the global market all of a sudden look really small relative to the absolutely unprecedented break that happened at the beginning of COVID, when, again, demand dropped by upwards of 15 to 20 million barrels a day, 15 to 20% of overall demand. And you saw, unlike a kind of a gradual increase in inventories like you saw in the 2014 post-crisis, this is, we had an immediate shoot up in those inventories. And this is essentially why you did reach that point where WTI did briefly trade at negative values. Things were filling up extremely quickly, and no one had any idea how quickly production was going to cut back. Was OPEC going to do something? I remember at this stage, OPEC at the beginning of the year, when they had initially talked about cutting back production, it was actually the opposite, and they jacked up production. So I think on the next one here, if we see the kind of interaction of OPEC here, it was really this period here that something looks strange relative to this overall trend. OPEC had been generally cutting, both as part of the post 2014 forward reckoning of just trying to cut back and trying to figure out how to do a shale. But at the beginning of this COVID crisis, you had the most unprecedented kind of collapse in global demand on record, mixed with Saudi Arabia jacking up production by upwards, essentially to all-time highs, to try and discipline OPEC when they were squabbling about cutting back. But as we did see, they eventually did come around and really cut back. Now, the hard thing here, though, is that production is still all there. That production capacity is still very, very available. And if you look at the bottom chart, the implicit spare capacity that OPEC now holds is in excess of 10 million barrels a day between all of the major members. I'm not counting Venezuela here, because I think that while Venezuela has been declining, I don't think we can count that as spare capacity. I think that's mostly lost capacity globally now. But at this stage, that's actually not an overall bad thing, because we really have a lot of spare capacity in the system. So even if we do begin to rebound, recover, we have to do so for a long time. We actually need to get back to where we were and then some in order to work back through all of this excess supply that OPEC now has built up. Just before I go forward, I'm just realizing I jumped into my oil stuff without seeing if anyone had any kind of roundup questions specifically on the kind of economic government role, those aspects, kind of before I kind of dig into the barrel, so to say.
So Rory, I have a question here from someone asking, in your opinion, how important and effective are government initiatives at securing new investment and employment in growth industries?
So I think in this kind of setting, you need to consider what the alternative is. And in many of these moments when there's a lot of money sloshing around equity markets, kind of asset markets broadly, property prices are doing very well in most major global cities. There's a lot of money out there, but because of the level of uncertainty, people aren't that interested in putting it into big bets. People aren't tripping over themselves to put $10 billion in a new facility in the ground today. This is one of the things that is that's difficult for the Canadian sector's, the Canadian oil sector's growth writ large in the future, is that unlike U.S. shale, really if you're dating a shale well, you're really setting up to marry an oil sands facility, because it's a 30 to 50 year type of project. You have massive upfront costs and a lot of, it takes a very, very long time to pay that off. And because, we don't know, over the course of my career, the definition of peak oil has changed from meaning not enough supply to peak demand. And that transition itself, I think, would have been completely unthinkable a decade ago. So I think anyone that pretends to know what the oil sector is going to look like in 30, 40 years is fooling themselves. But let me try. And I think that we're probably going to have, I think that oil demand growth writ large is probably going to peak sometime in the next decade or so. And then I think we're going to have a very long plateau and then a gradual decline. That I think there's still a lot there for the Canadian sector to monetize, and I think there's still a lot of opportunities there. But it's no longer going to be that, you know, the type of sentiment that initially launched, you know, 1,000 oil sands projects was Goldman Sachs reports talking about $250 oil prices in the forecast horizon, and, you know, permanently running out of easy supplies of oil. And I think that is entirely behind us. And I think that changes the type of risk appetite someone has for spending $30 billion on a project that's going to take them 50 years to return. So, and just to kind of go back to what you were saying specifically about how government money is different, it's government can take those risks. Government is happy, particularly in a crisis, to take those risks, to try and spur some economic activity, to try and, you know, kind of create some jobs. But they don't have the same types of kind of shorter term time horizons and kind of skittishness about risk that I think, you know, if even looking back decades and decades and decades ago, before this all really started in earnest in Alberta, you know, the initial Syncrude facilities, a lot of the initial oil sands projects themselves were funded by government money. They were joint ventures with the government. You know, this was initially completely speculative investments that ended up turning into Canada's largest industry. So, you know, I think we never know what that's going to look like, and I'm hesitant to kind of worry that the government money isn't going to be as well spent as the private sector money, because I think, you know, both private and public sector money can be well spent and be poor spent. It just takes, you know, people just have to be smart and lucky with how they're spending the money.
For sure. So here's one more government related question, although it's not ours. It says, and you knew that this was coming, Rory. I was watching the final presidential debate last night. Trump asked Biden what he would do with the oil industry, and Biden said he would close the oil industry, and later said he would transition away from the oil industry, and then later clarified that he would stop giving federal subsidies to the industry. My question is, how does Biden's position on the oil industry in the US affect Canada's oil and gas industry?
It's a good news, bad news situation. The good news is that if a Biden administration does, let's say, ban fracking, which he won't, but let's say he did, or at least ban fracking on government lands like in Nevada or in offshore or whatever, all of those types of policy positions are going to, all else equal, reduce U.S. supply in the market and U.S. growth. Given that the U.S. has been the primary, actually, I'll just switch here to this next page. If you see on this page here, you know, the U.S. Kind of oil sector was the main contributor to growth and supply over the last 5 years. You know, no one else even came close. You know, the U.S. sector, the shale sector, was what initially prompted that collapse in 2014 forward. It also stifled any kind of significant rebound from 2016 onward, because, you know, U.S. oil shale, call it shale 2.0 at that stage, had cut costs, had kind of got back in. Now, if there was, let's say, a White House that was, someone in the White House that was more hostile to that sector, that, again, all else equal, means less U.S. supply, higher prices, more room for Canadian crude. That's the good news scenario. The bad news scenario with the Biden presidency is that most of our crude travels south. Now, obviously, the clearest example of this is Keystone XL, and that's, I think, a lot of where this focus, you know, the 10-year long running project that just can never ever get across the finish line. The challenge here is that the shifting currents in the Democratic primary wing are fairly progressive. Some would say radically so on a whole host of environmental kind of issues, but they're particularly hostile towards tar sands, or, you know, as people will pejoratively call them, you know, our oil sands sector. Because of that, if you view the entire, essentially one half of the political spectrum of the United States increasingly being hostile to the idea of Canadian crude, and then combine that with the fact that the president of the United States essentially has unilateral, almost unchallengeable authority over licenses and kind of rights of way across the U.S. border, across which all of our pipelines travel, it creates a very precarious situation that it's one thing to say, you know, with Keystone XL is a great example, Biden has said that if he gets in, he's ripping up the approval on day one. The current administration in Alberta, the Kennedy administration, has put money and effort towards the Keystone Pipeline. And I think at this stage, there's a little bit of a, playing chicken. There's a little bit of a gamble that, okay, well, if we've basically built the entire pipeline, Biden's a reasonable guy. He's not going to rip it up. He's not going to rip the pipe out of the ground. He's not going to throw those people out of work. I hope so. But I think the important thing to remember here is that he is absolutely within his legal rights to do so, and he's explicitly said he's going to do so. So I think at this stage, it's, that's a pretty worrying point on Keystone XL. But the more worrying point is all of the pipelines that go across the U.S. border, Keystone, the main line, Enbridge's main line, all of these things are kind of governed under that same authority. The U.S. president, if let's say a really radical environmentalist got into the White House, they could cancel all of the licenses across the entire border tomorrow, which would essentially strand all of the crude in Canada, and we would have to figure out a way to truck it out to Vancouver or something. So that's the big risk, and I think that's an exceptional tail risk. But I think when we're thinking about the oil sector and how to monetize and how to make value of it, whether or not it's I don't think something like Energy East will be kind of reborn, but I think more projects that kind of take Canadian territory and go through Canadian territory, I think are going to be much better bets in the future, just because at the end of the day, in the case of the Trans-Mountain Expansion, the federal government bought it. They have essentially sovereign authority over interprovincial trade. They can do whatever they want. The courts really can't stop them there. Now, on the United States side, we have no such benefit with any of the courts and any of the state levels. And at the end of the day, there's always that particular tail risk nuclear option in a Biden administration, or call it some kind of future Democratic administration ripping up all the licenses for the main line, I think, which is the absolute nightmare scenario. So I would say practically, probabilistically, I think it's probably a reasonably good thing if a Biden administration gets in for Canada, just because of more cooperation, more trade, et cetera, et cetera, et cetera. But the tail risks, I think, are very much there. And the important thing is that the tail risks are not idiosyncratic to Biden. If anything, Biden will probably be the most conservative kind of Democratic nominee for the foreseeable future. So I think that tail risk is there, and I think it's only going to grow over time.
Thank you, Rory. We have a number of other questions, but I'm thinking that why don't you just carry on with your presentation, and we can save them for later.
Perfect. So as I was just saying just pull a second here. As I was saying on the U.S. production side, as you see here, COVID and the price collapse, U.S. production is very, very sensitive to price movements because it's so short cycle. The benefit of Canadian production, if you will, is that essentially most of our money's in the ground with very, very low operational costs for most oil sands assets that allow us to kind of produce at a low incremental cash cost. Sure, the project right now isn't making money on a full cycle basis, but it's making money off each incremental barrel at this stage. In the United States, it's very, very different, that instead of 20, 30, 40-year time horizons, most of the oil is produced in the first year. So changes in that kind of current price of oil have a very, very rapid transmission to the overall production in the United States. And actually, this is a great example of this. If you look at this right-hand chart, you can see essentially the relationship between the dark blue line is oil-directed rigs currently in service, currently drilling out somewhere in the United States, and the blue line is WTI with essentially it's pushed forward by 18 weeks, which is I found to be roughly the best tracking between the two. But as you see, there's a very strong relationship that these rigs counts do follow prices up and down. That's just how the sector sees its price signal. But if you look on the left-hand side, what's interesting here is this is how I kind of examine the changing character of the U.S. shale sector. That for a long time we had really, really high rig counts, and that produced enough oil. But then what you started seeing is during that kind of this period of the mid-2010s, something changed, and the rig productivity, essentially the amount of oil that each new rig was putting out, was skyrocketing. And this is both because of increasing kind of familiarity with shale reserves, but also because they were getting much more advanced rigs. So as you see this kind of red line, this rig efficiency just keeps continuing to trend higher. But the overall rig count is now, at the lowest level at least in this kind of like 15-year plus period, which is, eventually rigs are going to have to rebound, or U.S. production is going to keep falling. And I think at this stage, if you look at the relationship, it doesn't, at least right now, look like prices are anywhere high enough to incentivize U.S. shale drilling to continue anywhere near the pace it was going to be prior to this. So again, I think OPEC's holding it back. U.S. is not voluntarily holding anything back. They're just seeing their production fall because of pure economic reasons. I think this is something that's going to continue. You're going to see shale come back in some way in the future, but it likely will not see the type of gangbusters growth that we saw in the initial phase, that they kind of call it phase one in the kind of early mid 2010s. And then again, when it kind of rebounded in the 2016 forward period. I think this is now, what I was saying earlier about oil producers being increasingly viewed by markets, equity markets, as poor stewards of capital.
Rory, I think we've lost you. We just can't hear you.
Sorry about this, guys.
We can hear you now.
Okay, perfect. Sorry about that. So I'm going to kind of go back here. So we can still see everything now, okay? I apologize for a bit of the echo now, but I will try and speak softer so I don't echo in my own room. So moving on from the US, and kind of this is where we're going to get right into the Canadian sector. And again, these are just some charts that I put together to kind of help conceptualize, to visualize, kind of structure my thinking around this sector. And the first thing that I want you guys to look at is this, my attempt at visualizing the anatomy of the WCS discount. Okay? As I was saying, there's always going to be this quality component because it's a relatively more difficult type of crude oil to refine. And then there's also going to be this massive transportation component. That's the big variable part that moves more, with bottlenecks in the capacity of Canadian pipelines. So when you see here in this kind of late 2018 period, this gigantic spike in that light blue, that was that acute pipeline bottleneck. That was at that stage when we were essentially hemorrhaging, tens of billions of dollars a year in money that could have been going towards revenue, company revenue, towards tax rates, towards royalties, essentially getting obliterated by the because of this bottleneck, of only a couple 100,000 barrels relative to the overall millions of barrels that travel through the system. But those couple 100,000 were just overstripping pipeline capacity and rail capacity combined. And that was really bringing it was reducing the value of every barrel. If you see here as well, the Canadian, this is just a way of visualizing some activity on the various pipelines in the country. And what you can see here is that because of Keystone and Trans Mountain more or less being on a firm, most of their throughputs and their shipments are on a fixed contract. They really haven't seen much movement in COVID. But what you did see on the main line, which is by far the largest kind of pipeline system out of Western Canada, most of the loss in shipments were seen on the main line and seen in the rail system. I think the rail is next. One of the things that has happened with the pipeline system is it's provided us with a really, it's obviously a terrible thing for Canada and for the Alberta oil sector, but it was a great thing for an economist trying to follow the sector because it provided a much higher frequency data point than most of the data points that we get from Statistics Canada or the Alberta Energy Regulator or anything in between. That a lot of these are monthly series that are lagged by 1 to 2 months at minimum. Whereas with the oil by rail, it's really, you know, you have some monthly series, and you have a lot of weekly series from CN Rail, from CP Rail, and you have all of those the prices, which also provide a really strong signal that when the differential falls, the discount for WCS falls below 15-ish barrels, $15-ish a barrel under WTI, the profitability of shipping oil by rail kind of starts to evaporate. And as you see here, when, you know, this yellow shaded section on this right-hand chart is my estimate of roughly the level, a range that you know, the differential needs to be in order for that oil by rail trade to make sense. And essentially that's because the oil by rail system and the entire mechanism is essentially an arbitrage between, you know, buying relatively cheap crude in Hardisty in Alberta and shipping it somewhere else in the United States or some refiner, it's going to pay a higher price for it. As long as the cost of transporting it between the two locations is less than discounts in the place, you make money. But in this case, when the differential, or essentially the prices in Alberta get bid up because there's less and less production because people were cutting back production and you had curtailment and you had economic shut-ins, all of a sudden that crude is relatively more valuable in Alberta, which essentially implodes that entire oil by rail trade. As you can see here at the beginning of 2020, we dropped from upwards of 400,000 barrels a day of oil by rail shipments, which were the highest ever on record out of Canada, to less than 100, which is, you know, really the lowest point it's been since the entire oil by rail system started. So one of the things that I would say is that historically, we think of a high oil price differential, high WCS discount as a negative thing for the Alberta oil industry because it means not enough pipelines. But in this particular moment, I actually think that what we need to see and what we want to see is the differential get higher again, because we knew going into the COVID crisis that the differential was about $20-ish, which means that, you know, that was just enough money that you were paying for rail. Rail was growing. You didn't have enough pipeline space, so you weren't getting the best possible price for the crude, but it was pretty good and everyone's producing. These differentials that we see, these lower differentials, are not because of more pipelines or more rail, it's because of less production. So we actually want to see the differential start to rise again, and that will be our kind of rapid signal that things are starting to improve. And then we can go back to worrying about pipelines, which again are a long-term concern, but in the near term, you know, we need to get production back up and we need to get the rail system back working. I think we're still, you know, a couple 100,000 barrels a day off of that point at this stage. This is just a visualization I put together just to kind of show a couple things. One, to show the rough decomposition of costs in the oil sector. And these are specifically all the projects that the Alberta government tracks for royalty calculation purposes. But you can kind of see a breakdown between operating expenses, the diluent costs. If you're not directly refining it at a syncrude facility, you need to dilute it with usually condensate or very, very light crude oil to get you that blended WCS barrel that is more marketable. But what you see is that really, you know, a lot of the sector is making money. If you look at the realized price, this kind of orangey line here, you're looking at, you know, pretty good. You're looking at probably 80% plus in most of these years of the sector making money. But the one thing you'll notice is that as in years like 2018, where the differential was exceptionally wide for WCS, it was a double whammy to Canadian oil producers, because not only are you getting less for your less kind of realized money, that WCS is really dragging down that realized barrel price for producers, but it's also inflating the value of the diluent, because the diluent are incremental kind of diluent purchases actually come from the States, which are tied to WTI and it's a lighter crude. So when WTI is high and WCS is low, not only is it bad because you're getting less for your crude, but also your costs of goods essentially are also higher. This just kind of gives a bit of a historical perspective on the relative importance of, this is not as a share of the economy, but specifically a share of government revenue. That really, it was the heydays of the kind of late 70s, early 80s, when, combined between oil, conventional oil and natural gas, you were looking at over half of the Alberta budget was being provided by these types of royalties, which is why, and we see natural gas again in the kind of mid 2000s, and then oil sands kind of coming up here in the mid 2010s, but still never to as an overall size, never comparable to those other two big peak periods. These royalties are what has allowed the Alberta government to have relatively high kind of per citizen spending on programs, but very, very low taxation levels. And this is, you've had all these resource revenues to plug the hole. So when we talk about, a future of lower oil prices or lower profitability, that means, that really translates to, both a worse job prospects in Alberta, but also either a combination of lower government spending or higher taxes, which also kind of starts to strip a little bit of money out of the system, which makes things more difficult. One other thing I'll point out here is that if you look at the right-hand side of this, actually, just make this full screen again. If you look at the right-hand side of this, what you'll notice is that a lot of the royalty payments are actually more sensitive than the overall revenues, because a lot of the royalties, the royalty rates escalate faster when the producer is profitable. So it's not just a one, the government gets X percentage of whatever you get. It's actually, most of the time, it's X percentage of whatever profit you make. So that when revenues really collapse, let's say, after the 2014 price collapse, or when differentials are exceptionally high in 2018, it actually hurts the government's take even more than it hurts the oil sector's overall revenue take, which I think is just again an interesting thing to consider when you think about where the pain is going to be felt, primarily from hard commodity markets going forward. It's not just this sector; it's the entire economy and the government spending on that. Now, this is the slide I'm going to end on. I'm going to leave this up for a little bit here. Because I think this is the one where I kind of try and pull some of this back together for, what it means. Because most people, I don't know the makeup of, everyone on the call, but, a lot of you work in some kind of capacity or role, or have worked in some capacity role in the oil sector, but maybe you weren't a crude oil trader or whatever. Like maybe the spread doesn't matter as much to you, but what you really should think, so the spread I think is important because that's the realized price, but a lot of the sentiment of the overall market is really driven by WTI, Brent, essentially whatever price of oil you see quoted on CNBC or Bloomberg or CBC for that matter. And if we look on the right here, you can see the Canadian oil and gas capital expenditures, essentially the amount of money that they're putting into expansion, running, etc. I think this includes everything except labor costs. But what we see here is that as the price spikes, it's very sensitive to these price movements. And as the prices rose higher and higher, that's when we first got that first big influx of money into Alberta in the early 2000s, when people, prices first started rising higher. That's when we heard about $200, $300, $400 oil, and people thought the oil sands were going to be, the key to North American energy security. And we're talking about, Saudi Arabia, the North, and all of this, hundreds and hundreds of billions of dollars were flooding into the sector. A little bit of that tipped back by the financial crisis, but as you see, it really bounced back very quickly. And it was actually more this investment money than the actual production of crude oil itself that drove the strength of the Alberta labor markets across the board. I think that's the thing I really want to drive home here, is that if you look at the right-hand side of the chart, the dark blue is the Canadian unemployment rate, the light blue is the Alberta unemployment rate, and then the light pink is the Alberta wage growth, and the dark red is the Canadian wage growth. And what you see is a very strong split here. Before 2014, Alberta wages, trended in the same direction. If the economy was doing well in Canada, it was doing better in Alberta. It was all, growth was stronger. You had 15, 16, 20% year-on-year average wage growth, or this is, I think, average weekly take-home earnings, which includes overtime. But things were busy. People were getting paid a lot of money in Alberta. The wage rate was bid up. It wasn't just oil sector workers; it was construction workers, and it was everyone in between. When I was in university, I remember hearing stories about, a drive-through worker in Fort McMurray at Tim Hortons making $25, $30 an hour. And that was a big part, frankly, I'll be completely honest, that was a big part of the reason I got interested in the sector. I'm like, wow, that sounds like a great place to make money. And it's really interesting. But what you see is after the 2014 collapse, which was also just about when I started at Scotiabank, ironically, so my timing was poor. But when I got into this, this flipped. And all of a sudden, not only was there an outright contraction in the average weekly take-home pay in Alberta, when it was only essentially flat in the rest of Canada, but after that period, the wage growth in Alberta has lagged the rest of Canada substantially by about the same portion that they were running ahead of it in the good times of the late 2000s, mid 2010s. And same on the unemployment side, that through all of that kind of pre-2014 period, the Alberta unemployment rate, while more volatile, was always lower than the overall Canadian unemployment rate. And now after, what do we see? The unemployment rate after 2014 into 2016 was higher in Alberta than in the rest of Canada. And then when COVID hit, it jumped even higher in Alberta than the rest of Canada. And as we kind of come back down, it's staying higher. It's stubbornly higher in Alberta. So what I really want to get along here is that it's, there's two different discussions to have. There's one, which is are the oil sands dead? And I think the answer there is fundamentally no. The oil sands will be producing millions and millions of barrels of oil for decades to come. They'll be a very, very core portion of Canadian overall kind of economic capacity, of Canadian exports, etc. But that big heyday of big investment, hundreds of billions of dollars coming into Canadian economy, bolstering the Canadian dollar, but also bolstering, most acutely the Alberta labor market. I think that's really what is mostly behind us, because of the uncertainty of future demand, concerns of peak demand, and a general preference in the sector to move away from higher carbon, longer lifespan projects towards trying to have shorter kind of time spans or lower carbon, or I think, in the kind of cynical way of doing it, in countries that we don't need to see it produced for now. And I think that's, there's all of these things playing, but I'm now happy to open it up very, very broadly to any questions. There's a ton of things I didn't cover in this, obviously, but I'm really kind of excited to kind of hear some of how you guys are feeling and how kind of where your major kind of curiosity points are at this stage.
So Rory, there's one that might be kind of timely right now, and this pertains probably because you are from Toronto. We have a lot of our clients that are looking to, they're looking at the options of potentially pivoting. And I mean, that's a pretty important decision to make, especially when, they've spent the last several decades of their career doing in one particular industry. Yeah. So one of our clients is asking, how can oil and gas displaced professionals make themselves more attractive to non-oil and gas companies, especially some of the younger, more innovative ones? And the reason for that is that preconceived ideas are that oil and gas people want too much money. They'll go back to their former industry as soon as the oil price recovers, and they don't have the right skill set. And it's easier and cheaper to hire more junior people and train them rather than retrain an oil and gas professional. So for those that are contemplating a pivot, what are your thoughts around that?
So first, I'm just going to speak from personal experience here. I obviously left Scotiabank, where I kind of led research around commodity markets, and specifically most of the 80% of my time was on oil markets, Alberta economy, oil sands. I think I made the decision to leave that space partly because I had done it for a while and I wanted to try something new, but I also think it was largely because you could see, did I really want that to be my only focus, given all of these other trends I'm seeing and all of these headlines I'm seeing? Every time when I was working at Scotia, you would see, an executive would come and say, "Oh, did you see that FT headline? Financial Times headline where London is going to ban all, internal combustion engine vehicles by 2040, or California is going to do it by 2030, or you have all of these other, all of these things flying around. And I think it's, my job at that stage was essentially to moderate or kind of, modulate some of that fear and that concern, but also kind of really highlight the risks that were there. And I think that, while, again, I firmly believe that one, oil will be consumed in not that dissimilar a volume 2 decades from now as it is today. But I do think that itself is a fundamental change from what was historic. I think what there's it's typically seen as pejorative to compare the oil sector to the coal sector, because the coal sector got a very, very bad name. I think in many cases rightfully so. But the similarity here is that the coal sector has now been dealing with relatively stagnant to declining demand. There can still be lots of companies that operate and make money in that sector, but it's a changed sector. It's no longer one that's defined by big bonuses and growth and fervent and attracting new young people and all of these things. That's what changed. And I think that if you are in that situation now, either early in your career or later in your career, a lot of the same skills apply to all of these sectors, whether it's communication skills, whether it's numerical balance sheet accounting skills, or economics, or what have you. I think the classic refrain, and when Jackie first reached out to me, it was partly because I had been on a podcast with CBC, and I had said, the classic refrain, particularly from people from Toronto, is that, oh, well, the oil sector workers should just learn to code and they can all work at Apple, or they can all work at a tech company or whatever. One, I think it's pejorative because not everyone needs to learn to code, not everyone should learn to code. But I think the other thing is, too, many of you in your jobs right now, whether it be engineers or accountants or financial professionals, one, already know how to code. So those skills can be transferable. But I think all of those skills, I hear that where the questioner is kind of coming from about this perception that oil sector workers are flighty or whatever. But I think that will take time. I think making it, telling your story and telling why you're transferring from this sector to something else, I think is always important. I'm a big believer in personal narratives. But I think it's also, over the next couple of years, the rest of Canada is going to understand. You're going to start to understand that Alberta is no longer the place where you have gangbusters wage growth every day. That it's no longer the time when that barista was making $25 an hour. Times are different now. I think a lot of people understand that, I think I'm hoping there will be a kind of national empathy towards the people that are going to be moving away from the oil sands, much as I think a lot of the country sent a lot of workers into the oil sands when times were booming and labor markets were tough. So a lot of that comes down to the mobility of labor markets, but that's very, very challenging for people that have already set up roots, that have communities, that have families in Alberta. But that actually is one, if we could look at one of the benefits of, one of the very, very few benefits of COVID, is that we are now having this event via Zoom. Our office, we really haven't been in since, February. I spend most of my time up in a farm north of the city now to kind of completely stay out of Toronto. Part of the reason I'm in the city is to have internet that works for this call. But other than that, I think all of these things and companies are going to get better at accommodating this. We've already started to see up north where the internet's always been terrible. We start to see telco companies start to expand broadband north with this full understanding that people, this is not just a thing that people living in the cities now. People need to be able to take, have low latency, internet everywhere in Canada, because this is the way things are going. So I think that I think is one of the benefits of COVID. Is it's kind of not just demanding an increase in business flexibility, but I think also increasing the empathy of people that are understanding of people that are working at home with kids, or having kind of non-traditional working arrangements. I think that they're all the rage now.
So thank you so much, Rory. So on that note, are you able to comment on Ontario's appetite, say, for hiring an Alberta oil and gas professional?
So I'm going to split it into two kind of points. One, right now, it's hard to get hired anywhere. The overall economy is so, hurt. If you look at this kind of chart underneath here, the overall Canadian unemployment rate is still dramatically elevated from where it was. And a lot of people are kind of a lot of businesses are depending on whether it's emergency credit from the government or emergency kind of wage support from the government. So I think it's difficult right now to get hired into some of those traditional employers. I'm thinking of in Toronto, for example, the banks, the accounting firms, the professional service firms. I think a lot of those companies right now are kind of, if not explicitly in kind of hiring freeze mode, they are implicitly. That said, there are a lot of people. One of the interesting data points I saw in the United States, and I haven't seen Canada, but I would assume it's similar, is the proportion of business formation, new businesses being formed, are at record highs. Because when you don't have the employment outlets, if you can't get a job at a bank or an oil company or an accounting firm, then maybe you try your own company. And particularly when you have these, if you're just starting out and, let's say you have the benefit of receiving CERB payments, all of these things, people have a little bit of time, a very unique circumstance. I think this is the one moment as well where I think that, you always hear about resume scarring from people being out of work for too long, and it's, this big gap on a resume, and these questions are asked. I think a lot of people are going to have that gap during this period. So I think that also makes it much easier to explain and say, well, I was at home taking care of my family, I upgraded these skills, I did these things. I think there's a lot of bandwidth and I think it's just again, I keep coming back to empathy, but I think one of the things that I've noticed in the people I'm talking with is I think everyone's just a bit more understanding of everyone's kind of personal circumstances right now. And I'm hoping that kind of stays. But I'd say that's, it's hard to find work anywhere right now, but I think use some of the time and the opportunity that we're kind of provided by various policies to kind of figure out whether or not it's, to make the right choice. I don't think it's not necessarily about finding the first choice. I think it's about trying to find something that you can be as passionate about as oil, if that is what you're passionate about that brought you to the oil sector in the first place.
Right. So here's one, it's somewhat related. Suncor announced October 2nd, and so have other energy companies since then, international ones, that it will be cutting staff up to 15% over the next year and a half. What would you say to those employees and other oil and gas employees that may be facing layoffs in the future about career transition, and what are the emerging industries and markets that they are trending right now, or that are trending right now?
Yeah, I mean, so Suncor is obviously the main big Canadian one that the headline in Canada. I think it was, over 1,200 jobs, something like that. The Shell came out recently, talking about 10% of its workforce. Exxon a couple of days ago said that they're about to hand it down. This is not just, this is a sector-wide phenomenon. Again, if we remember what that chart of equity price performance, stock price performance of these companies looks like, they're under tremendous pressure to cut costs. They need to do something. They can't control the price of oil. That's one of the downsides of being in the oil industry, is that you have no control over the most important input of your entire business. So it's always been a bit of a difficult, industry to be in broadly. Sorry, and I'm just completely, what was the initial question again? I got off on a tangent there.
Janelle, would you like to ask it?
Oh, okay, sure, Jackie.
Hi, Janelle.
So, hey, thanks, Rory, for your presentation today. So, yeah, I just wanted to ask you, with regards to Suncor and other oil and gas companies that are going to be laying off people in the next, a few months to year and a half, like, what would you say to employees in companies that may be potentially facing layoffs in these industries about career transition? And what are the emerging industries and sectors that are trending right now?
Okay, yeah. So I think that, it's unfortunately something that I do not think is going to remain isolated to Suncor. I think that I was hopeful that it would take a longer amount of time for the layoffs that we saw at those big international, kind of the Exxons, the Chevrons, the Shells, etc. I was hoping it was going to take a longer time for those to hit Canada, but it didn't. And I think the thing about COVID as well is it's giving a lot of companies that maybe always wanted to cut payroll, but often when you cut payroll, it sends signals that can be misinterpreted, and there's a lot of concern. So that when the entire industry starts doing it, it essentially gives permission for other companies that always wanted to or need to do it. So I think there's a lot less resistance to payroll cuts right now than there would have been even in the kind of depths of the kind of 2014 to 2016 period. So I think that's one thing. I think in terms about what I would say to those people, kind of tying back to that last question, it's about what I think it's about what you do at the oil company or whichever firm that you're working at, what you like about it. Because a lot of people, I mean, a large portion of a oil company's workers never touch a barrel of oil, either physically or even kind of digitally. Much like I worked at a bank and never needed to step foot in like a retail branch. So I think there's always different components to a company this large, and I think it's not the same answer for everyone. Someone that's really interested in geology, for instance, could be very interested in trying to find, whether it's lithium or copper mining or associated commodities that are either essential or kind of associated with the new energy or the green energy revolution. That's obviously a point. I think a lot of Canadian commodity commentators are focused on. We have great copper reserves, lithium, hydrogen, nickel for EV batteries. All of these things Canada has in large supply, and maybe that's the next thing. Maybe we become an even larger mining superpower than we've been in the past. But for the people that are in finance or treasury at these companies, I would argue that the types of role they're doing is much more common to a similar person at a bank or in government, frankly, than in a mining company. So I think it really depends on kind of who you are and what you're doing and what you're passionate about. But I always try and. My wife was telling me that I needed to try and find the most hopeful kind of expression of this sentiment, and Jackie was telling me to just be honest, and I think it's difficult because I think it's obviously a year ago none of us had any idea that COVID was coming. No, 5 years ago, 6 years ago, no one had any idea the price of oil was going to dip below $100 a barrel. So it's about trying to figure out a way, trying to find, I think, thinking about yourself less as a sector person, less as an oil sector worker, and more as a worker that's defined by the skills you bring to the organization, no matter what sector you're in. So I was an economist at a bank, but my main skills were, data analysis, communication, et cetera, et cetera. I think that's, I could do that for government. I could do that for laws. I could do that for anything in between. So it's trying to figure out what value you bring to the company, and then kind of repivoting your perception of your career search that way. It would be, if that's helpful.
Thank you so much. So everybody, did you hear that? It's about the value you bring. That is awesome. That's everything that we teach, Rory. So thank you so much.
Fantastic.
So here are some questions more about investment, and they're pertaining to what are some of the macro trends used by Bay Street to determine that the energy economy is recovering, and what are they investing in right now? For instance, are institutional investors still interested in the blue chip energy sector, or have they shifted their capital into other industries such as renewables, tech? And how readily is capital available to oil and gas companies? And the other thing too is, I guess, with the burgeoning blue hydrogen technologies, are investors interested in putting capital into the diversified monetization of natural gas? So there's a lot of questions there, but they kind of pertain.
I might ask you to remind me of some of the particulars as I kind of go through. I might get lost again, but generally, I think that. So we've got hydrogen, and what was the first part?
What is the sentiment on Bay Street about investing in the energy sector?
Availability of capital. So essentially, availability of capital for the kind of oil sector, the Canadian oil sector specifically, and then kind of going forward. If not there, then where?
Specific as well to Alberta.
Yeah. So I would say that the overall sentiment right now is obviously quite dour. I think it's, if we look back at the kind of that, just to kind of bring it back here, that equity chart, you know, it's really, really, this is for the S&P 500 in the United States, but the Canadian equivalent it's a similar story. Tech is outperforming essentially everything, and the oil sector, the energy sector, these kind of traditional, particularly the oil sector, is, you know, at the very, very bottom of essentially every single leaderboard. So the question about whether or not people are going to invest in equity, you know, energy equities, right now it seems like the answer is no. Some value investors, some people that think those could be good buys, you know, a contrarian at this stage. I think there's some appetite. There will always be some appetite to take the other side. But I would say overall, investing in the equities at this stage at least doesn't seem like the most appealing thing to do. And if you're talking about, you know, the availability of international capital, one of the stories we've seen over the past half decade, just a constant churn in Canada, is international oil companies leaving Alberta and selling their stakes in a whole variety of companies to Suncor, to CNRL, to everyone else. So the overall Canadian sector has become much more Canadian than it's really ever been. So that on one side, it's, again, I'm constantly full of good news, bad news stories. The good news there is that, one, any profits stay in Canada. That's great. It's good. And that Canadian companies, you know, that's their main bread and butter. Most of these other companies, the Exxons, the Norwegian, state-owned company, all of these other companies, you know, this was very peripheral to their main oil production businesses. So they maybe didn't understand the product, the process as well as, say, Suncor or CNRL did. But that said, you know, Canada, the way that the Canadian oil sector grew was by just vacuuming up global international capital for expansion. That was that big period, those huge kind of tens, hundreds of billions of dollars of fixed investments coming in. That was a lot of that was international. So when you talk now about essentially every company, most internationals pulling out, very few, whether it's, you know, European banks blacklisting credit availability for Canadian companies, whether or not it's Canadian pension funds that are talking about the same. Now, there will always be a little bit of support for those equity valuations because a lot of those companies are included in like the TSX index. So there is going to be a passive contribution. But in terms of specific kind of project finance, I think that's going to become extremely scarce and will be dominated by the largest, again, Suncor's, Husky, CNRLs, Imperials, that are the big players that are, I think, have the balance sheets. I think those will be the ones that kind of begin to take over a bunch of the other smaller companies and consolidate, which again, I think, again, from an efficiency perspective, from a cost perspective, all very good, but from an aggregate employment perspective is bad, because typically when you have a big company take over smaller companies, that more or less washes out a good chunk of the head office, the kind of overhead work. That's, from the company perspective, that's the benefit. But from the labor force perspective, that's obviously an unambiguous downside. So we always come back and forth. And if the money isn't coming in, I think, again, the Canadian sector will be able to fund, I think, modest incremental growth, brownfield expansions, kind of expansions of pre-existing projects that kind of won't take a big environmental review and everything else. I think those will be the types of projects we'll see. So I think they'll probably see a couple 100,000 barrels more growth over the next decade or so. But then I think it's more or less going to flatline. And I think, and that's, again, barring some kind of material technological innovation that dramatically increases the efficiency of bitumen extraction or decreases the carbon intensity, or, you know, we've seen one fun little, pet policy project that I've always been fascinated with is this idea. One of the main reasons that the carbon intensity of the oil sands is so high relative to all global competitors is that you actually need to heat particularly in situ production, under the surface production, you need to inject hot steam directly into the ground. So you need to heat it to extract it from the sand it's commingled with. And a lot of that is produced either by natural gas or burning petcoke, which is essentially like the remainder after all of the more useful bits. It's essentially like coal, more or less, from an environmental perspective. But I've seen proposals, and there was a proposal floated a little while ago by a bunch of former Alberta premiers, and I think Saskatchewan premiers as well, that talked about small modular nuclear reactors in the oil sands in Fort McMurray to provide large amounts of zero emissions energy that you could, so those sort of things could dramatically change calculuses, but Alberta has always politically been relatively against nuclear versus some of the other Canadian provinces. So that might not be politically viable. But I do think there's lots of these types of ways that we can invest. I think there's two ways to view green spending in the economy and in Alberta. One are new things entirely, solar panels, hydrogen industry, et cetera, et cetera. The other is by spending money and investing to reduce the carbon intensity of productions that are taking place in the province. And I think Alberta right now, the government that we have in Alberta is probably going to favor that kind of that latter portion, that kind of helping the industry improve its profitability or decrease its emissions. And I think probably the government in Ottawa will lean to the former, which is, you know, new industries, exciting new things, you know, growth, growth, growth. I think we're probably going to end up somewhere in the middle. I'm a really boring sectorist, but I think that we're going to have a bit of both. We're going to have, I think over time, a lot of the competitors to the oil sands, OPEC and you know, US, like the US shale patch and everywhere else in the world, they have a lot of different risks, exploration, capital intensity, et cetera, that the Canadian oil sands doesn't have to the same degree. We know where 180 billion barrels of crude are. It's like right there. There's no exploration risk. The oil sands already are a bit of a tech manufacturing industry that's masquerading as an extractives industry. So I think that part of the things, and I think that's why the Canadian oil sector even, I think will have some kind of future job benefits that the shale patch won't in the United States. So I think it's, you know, it's always hard to tell exactly where the jobs are going to come. And I think anyone in government that's ever tried to spend stimulus to create jobs can attest to that. But I think it's going to be, I think it comes back to each person individually, kind of being flexible. Again, seeing and contextualizing, understanding how all this works together, how the market works together, so that you can kind of parse the headlines on your own. You can say, well, that's, you know, let's say the Financial Post or the, you know, going up, that sounds really bad, you know, but is it? Is it different? Is it a materially new thing? Because I think all of us, myself included, I think we all kind of feel a bit of headline fatigue, particularly even before COVID. It was, you know, every other week it was either a new layoff or a new pipeline delay or something. I think it's always good to try and spend a little time on that kind of base understanding to kind of contextualize those headlines in real time.
For sure. Thank you, Rory. Okay, I'd like to open the floor for further questions for Rory. Would anyone like to pose one? There's a lot in the chat.
Hi, Rory. It's Greg here.
Hi, Greg. How you doing?
Good. How are you? Thanks for your time.
No worries.
I put one in the chat, but I'll just verbally say it. So you have a unique viewpoint on the finance side. So you're probably aware within the oil and gas industry, they're kind of the first ones to really have that really hard look on ESG and sustainability, you know, and reporting with you know, meeting SASB types requirements. So from your perspective, do you see that same level will hit other sectors or these emerging commodities, or maybe not quite as stringent?
I think yes, I think it absolutely will. So let's say you're in charge of quantifying ESG variables at an oil firm. That will be a skill that will be very, very useful at a bank or you know, in a credit department at a bank. Or there are a bunch of consultancies in Toronto that help other companies with that type of work. I think those types of things will be very helpful, those types of skills. And I do think the oil industry was kind of a forerunner on this, because obviously it was one of the industries that was most kind of in the crosshairs for poor ESG performance, whether it's because of you know, producing oil in Niger Delta and the human rights of, you know, consequences there, or the you know, lackluster environmental performance of some Canadian oil companies. I think this is you know, all of those things. You know, it's been a trend that's been building for the last 2 decades. And I think that eventually we're going to get additional policy, structural kind of mandates that will kind of force the standardization of some of this. So I think anyone that has a kind of, like, eventually that policy will come, and eventually the entire corporate sector will scramble to try and figure out how to quantify their own particular carbon kind of budget, or, you know, track all these things in real time. You know, there is Mark Carney when he was at the Bank of England, you know, his Financial Stability Board, talked a lot about carbon asset disclosure and disclosing carbon in your supply chains, and essentially giving analysts like myself the data in a, you know, apples to apples comparative format that we can then determine who are better and worse performers in whatever industry. Now, as an example, in Alberta, you have, you know, at the project level, you have various carbon taxes that you know, will theoretically, you know, benefit lower, you know, companies that have, you know, below average emissions, and penalize those with above average emissions. That's one way that this could take hold. You know, whether or not it's, you know, carbon taxes continue to ramp up economy wide. I think the other way this will happen, and I think this will be a more direct kind of jobs and skills boon, will be if the government mandates, you know, a change in the accounting standards. That all of a sudden, you know, I remember when I was at Scotia, we had the changes that were IFRS 9, which is, you know, the new, you know, the global accounting standard. They changed to require a good degree of forecasting and scenario planning and probabilistic kind of assessments, so that you can kind of give a better kind of a better picture, a better kind of nuanced number to investors to properly value your company or to take a position on it. I think the same thing could happen. And when that happens, sorry, you know, the number of jobs associated with that at Scotiabank, you know, exploded. You know, I was doing a ton of work on this. A lot of other people were doing a ton of work on this. And I think that if we saw a mandate that you know, increasingly, you know, required, you know, a company like Canadian Tire, let's say, to quantify in a very explicit, kind of monetary way, the carbon kind of amount of carbon in its various supply chains, you know, someone's going to need to do that. So there's going to be a lot of back office jobs, kind of quantifying, tracking, kind of figuring out kind of best practices. Because it's also, there are about 800 different ways of quantifying those impacts. So, you know, whether or not you're currently doing the one that will win out on the policy side is an open question. But I think at the end of the day, over the next 5-10 years, I would highly suspect that we will have kind of regulatory changes to the way that companies need to report their exposures to these carbon risks.
Great question.
Just one follow-up, I guess, on the, you know, maybe more prominent lately, especially on the social side. I guess that I was kind of wondering, you know, that kind of crosses no matter which sector. So it seems like just because of the higher social awareness right now, because, you know, COVID kind of gave the opportunity, that just raised everyone's awareness levels, that the feedback I hear from the finance sector is that's a prime driver of potentially where capital is going to get directed if you have like 5 companies in the same, you know, realm to future-proof themselves, whichever one is kind of identifying with those and actually, you know, actioning on it and measuring it and being really transparent with it.
Yeah, I think absolutely. I mean, we've seen so many different, I mean, it's been an exhausting 5 years. I'm sure you all find it the exact same way. But like the number of kind of what feel like once in a generation kind of social upheavals before COVID, even whether it was Black Lives Matter or the Me Too movement or all of these things, you have financial sectors and financiers broadly looking at a whole host of risks that, oh, okay, well, maybe your CEO's a creep. That didn't enter into our calculations before of risk, but that could be, you know, that could be worth 20% of your stock price. So I think there's a whole host of kind of nuanced intelligence that's now being required because the risk environment is constantly kind of shifting. One of the things that I really like to do, I'm a bit of a control freak. So I like to call myself a full stack researcher. So everything from research topic to, you know, scraping the data offline to putting into visualizations, putting in charts like this, branding, going out to media, doing presentations like this. And I think trying to figure out if you're also on the analytics side, kind of how to, you know, there's a whole host of ever-changing tools. I learned a bunch, honestly, about Zoom for this call that I had never really used before. So I think all of these things are skills that will become incredibly useful. Because I think in times of heightened uncertainty, that your ability to be flexible in the application of your skills is as important as the skills you actually possess. And I think, also, I mean, most university students aren't actually physically in university. So if you don't need to go in a classroom to learn something, then you can always upgrade your skills at a whole host of kind of online. So that's what I've kind of been constantly doing. It's a little bit of a disservice to my prior comment about the tone deafness of the coding kind of suggestions, but I personally have actually learned a bunch more coding through this, just because I had the kind of available time and the lack of kind of other major priorities when we were all essentially hunkered down in March and April and just wondering if the zombies were going to show up anytime soon. So it's like, I don't know.
Awesome.
That's great. Thank you.
Thanks, Greg.
Okay, other questions, you guys?
Jackie, I have one.
Go ahead, Janelle.
As well.
Okay.
Okay. So Rory, I've been considering targeting a career transition into an Indigenous relations advisor role.
Yeah.
And so I think typically that type of role has been geared towards the oil and gas, energy sector and whatnot. Do you see a need for that role in other sectors? And do you see that there could be a potential decline in the need for that type of role in the oil and gas sector?
That's a really interesting question. I would say that the kind of awareness, so I think that there's two ways of, there's always a supply, there's like a pull, like a supply factor and a demand factor. I think that the, people are not, particularly after, all of the headlines that follow, and rightfully so, that follow the Truth and Reconciliation Commission and, all of the protests around pipelines and the Coastal GasLink of BC and every, and this has obviously been a major thing in the oil sector. Now, the reason it's uniquely kind of an oil sector focused risk right now is because few other sectors have such a large kind of initial physical footprint, say as like a major oil sands, like a Fort Hills Suncor project. It's a massive kind of scale project. But not only do you have that kind of displacement, because that's going to be similar to the mining industry, right? So I think a copper mine or a lithium extraction plant or anything that has a big physical presence, given where these resources are located, are often either exclusively on or crisscrossing across various tribal lands and band claims. I think that so that will always be a focus. I think the most obvious parallel to that for energy is the mining side. But the thing that makes oil uniquely kind of in need of this type of expertise is that they have that big main plant, and then they have a gigantic long pipeline that connects it between wherever it is and wherever it's going. And given particularly out west, the kind of crisscrossing and the wide scale of kind of Indigenous communities and land claims in the area, you really can't get between, let's say, Edmonton and the West Coast without crossing a whole number of various claims. So the combined factor of pipelines and big physical, initial locations makes the oil industry particularly kind of in need of these. So I think if the oil industry stopped building, I think is a point that could, relatively decrease the demand for those types of skills. But I think the kind of sensitivity to those things is also accelerating exceptionally. So I think at this stage it seems more likely that the acceleration of sensitivity is going to kind of overcome any downside of lower kind of investment in building at this exact stage. And then, again, if you're looking at a mine or you're looking at, something comparable to pipelines would be, power utility corridors and power lines and all of these other things. So in any kind of renewable system, you're going to need a lot of these same skills, and guaranteed that the sensitivity to those issues is going to be much, much higher than it has been in the last 15 years in the oil sector.
Awesome. Thanks, Rory.
Thanks, Janelle.
Hi, Rory. I have one question. Well, I'm Takir, and it's a very fascinating presentation that you presented here. It shows a lot of work behind the graphs and everything you put it. Okay, so did you get chance to look into what renewable is working better for the future for Albertans or for whole Canada?
Yeah, so I think it's important to think about energy and specifically oil's kind of role in the overall energy sector when we kind of think about this question. So it's well known that fossil fuels account for 80% plus of the kind of overall energy mix. But most of the oil use isn't going into the power sector. So oil, in most cases, at this stage, is not directly competing with wind or solar. Where that does cross over is when we start talking about electric vehicles and the electrification of transport. I'm liking the edits to the chart right now. That's obviously the main connection is the electric vehicles. So I do think that will become a major trend over the next kind of 20, 30 years. I personally think that my next vehicle after my current kind of diesel guzzler goes, I think it will probably be an electric. I've driven a couple and they're just fantastically cool to drive. So I think even outside of the environmental footprint, like they're super, super cool. In terms of where Alberta sits in this, Alberta in a lot of ways is like Texas, a lot of oil, a lot of wind. So I think, Alberta has been, a lot of wind resources, a lot of geothermal. But those right now are really only pushing into that electricity side that will eventually take over the oil side. But I do think that, hydrogen is that other one. There's a lot of things that as of yet, we don't know, we haven't figured out how to electrify. Concrete and steel and, all these other things that take a lot of, we call them industrial heat. That I think is where something like hydrogen is going to play a more direct role. Now, a lot of these discussions about the hydrogen economy in Alberta are still in very, very the early stages. But what I think is interesting is, it's not dissimilar to when people were looking at the oil sands 35 years ago and saying, oh, there might be something there. It took a while. It took a lot of government investment, it took a lot of risk taking. But all of a sudden it became, a massive, hundreds of billions of dollars of investment a year. So, I would say off the bat, it's, Alberta has a lot of things going for it, but it's hard to get around the fact that it has a lot of oil and gas. So I think in the immediate term, you're trying to figure out what else can oil and gas be used for other than burning. So one of these things is talking about extracting hydrogen from nat gas seams. You're also talking about, I mentioned at the very, very beginning, beyond and beyond combustion, various proposals to increase other plastics or petrochemicals production in Alberta so that you can both not need the pipelines in the same way, increase the value, capture the province. But it's hard to see how quickly you can, produce as much non-combustible product out of the oil sands as you produce combustible. So that's going to take a very, very long time. I think it's going to be paired with a whole bunch of, I would not be surprised if we saw that Alberta and Saskatchewan kind of leading in Canada on things like carbon capture and sequester. I think so many of these, we're in this Wild West period where, and I mean this, like, it's dangerous. Like, there's a lot of opportunities, a lot of risks, a lot of uncertainty, but again, there's a lot of opportunities. I think, it will likely be an amalgam of all of these technologies. I think I think fortunes will be made in hydrogen and wind and solar and petrochemicals and plastics production. I think a lot of these things, but I think it really is going to require kind of people kind of coming to terms with the fact that the oil sands probably are never going to grow again like they did in the 2010s. and figuring out what we can do to change that course. Because if you look 30 years ago, no one would have forecasted that you would have had, or maybe even 40 years ago, no one would have forecasted that the oil sands would have been the industry that is today. It just didn't seem viable at the moment. I think I see a lot of parallels between that and states like hydrogen now.
Interesting.
All right, thank you.
Hey, Rory, it's Paul Wilson here. Thanks for
Hi,
the
Paul.
presentation. Great presentation. I have a question. You mentioned a lot about alternative energy sources, hydrogen, wind, solar. You were talking about it, and obviously oil.
Yeah.
You haven't mentioned yet LNG, and LNG is one of those other aspects that is talked about for future investment opportunities for Canada, but then at the same time, maybe we missed the boat on that. Can you kind of hedge LNGs, your thoughts on LNG as a means of buoying the Western Canadian energy industry, please?
Yeah, so there's, again, lots of good things going for LNG, and I would say one or two big bad things. On the good side, if you're looking up in, northwestern Alberta, northeastern BC, there's a tremendous amount of gas up there that really is not being exploited to any degree it normally would, because there's so much gas in the United States. Essentially, our exports to the United States, which was traditionally the home of all of our exports, is just such a glutted market. Now, prices have been picking up, and I think that a bad market for oil is actually, ironically, a bit of a better market for gas. I think that's the first thing in North America, because in places like Texas, a lot of the gas that was being produced in an associated way from oil production. So less oil production means less gas production, which is why we've seen gas prices are kind of in that back in that $3 a million BTU range, which is like back to reasonable gas prices. When they were down at the low twos, that no one was really making money. Now, the answer to that being backed out of the U.S. market for Canada was, West Coast LNG. The United States is obviously doing this a lot around the Gulf Coast. But the challenge with LNG is that it's a lot of money and a very, very long time. And going back to the point of a lot of uncertainty. When I started in energy, LNG, people were building LNG import facilities in the United States because they were going to never have enough gas again. Fracking comes along, all those companies essentially went bust. All those plants were bust. Some of them got repurchased and then were converted into LNG export facilities. But we're talking these are what's crazy is that these are tens of, LNG Canada is like a $30, $40, $50 billion project. These are the largest investments in Canadian history if they really, come to fruition. And again, we're talking decades and decades and decades to pay them off. That's the big problem with these right now, is that I think gas makes a lot of sense. I think LNG as a way of mitigating climate impact makes a lot of sense right now. I don't know if it's going to make a lot of sense in 5 years. And I think if you're on an investment committee trying to figure out whether or not you're going to put X billions of dollars, X tens of billions of dollars into a project that could very, very well, materially impact the future kind of prospects of your company, that's a hard bet to make right now. So I would say that, things like solar and wind, they're not as energy intense as natural gas. It's not as flexible, but it's relatively cheaper, and you can go much smaller on those projects. You can diversify your risk across a whole bunch of different things for the amount of money it would cost to invest in an LNG plant. So I'd say that LNG, it needs a lot of things to go right for the sector to make money in the long term. Chief among those are things like China liberalizing its natural gas market. That was the big, one of the big things for a long time that was a sticking point, was that Chinese natural gas demand a couple of years ago just was not growing like it was forecast to be doing. It was only kind of eking out 1 or 2% growth a year when it was theoretically supposed to be growing at 10% a year. And that came down to regulatory issues, that you just didn't have a liberalized market for natural gas in China. So it's one of those things that you need the supply conditions to be right. You need to be bearish on battery technology and renewables, and you need to have a couple, 10, 20, 30, 40 billion dollars of capital to spend on that bet. And I think that's a shrinking portion of the pie right now. It's similar that what I was saying, that there's less and less international capital for the oil sands. I think there's less and less international capital broadly for big energy, traditional energy mega projects. I just saw, a article today about a massive new, mine in Australia for minerals associated with the renewable space. I think if you're going to be putting tens of billions aside right now, people I think are more, there's more capital that would fund the building of another Tesla gigafactory before a LNG plant. I think that's just true on kind of economic growth, but also true on that kind of the relative technological momentum of the two spaces.
Thank you so much, Rory.
Rory, it's Jackie Crystal here, and thank you so much for your presentation. Just a question that I had was, in Canada, we've spent a huge amount of importing oil from Saudi and Venezuela. I've got some stats here that it's 220 billion between 2010 and 2019. It's 477 billion between 1988 and 2019. So my question is, why does Canada insist on importing foreign oil? And would it not be wiser to actually use Western Canadian oil instead, and possibly put tariffs on importing foreign oil?
So the one thing I'll say with this, I think the thing that's really important to remember here is that point I was making about the requirements of an oil sector to have those pipelines, or a lot of seaborne and kind of water access. Fundamentally, the reason that we import crude oil from, like you were saying, Saudi, United States, other kind of what we would view as competitors for Western Canada, the reason we import that crude on the East Coast is because it's much, much, much cheaper to buy that crude from the East Coast than it would be to pipe it across Canada, or it's actually in many cases more economical to ship it West Coast. Take the tanker, put it down through the Panama Canal, and come back up to the East Coast. In many cases, that currently is cheaper than building a pipeline out east to kind of supply the same amount of crude. So while it is true that we spent hundreds of billions of dollars importing foreign crude, it's important to remember that that crude we were importing was the cheapest available. And then because of that, we got higher prices for the exports we were putting out of Alberta into the United States. So I think instead of thinking about it, as kind of wasting Canadian peso or wasting North American or Western Canadian oil, is in order to consume our own oil and not make Canada overall worse off, you would need to have a much, much lower price for Western Canadian crude, which would, you would be kind of like robbing Peter to pay Paul, right? You would kind of be you'd be benefiting, one level while actually on a very large aggregate basis, actually doing economic harm. So it's economically most efficient to import the cheap crude east, sell our Western crude into the Midwest and down to the Gulf Coast for higher prices, and then kind of pocket that difference. Because otherwise, that's where I think that's where it makes economic sense. Now, the one thing I will say to that point is what I was saying earlier when we were talking about a Biden administration is, as of right now, that makes sense, right? Because we can ship really as much oil as we want south to the United States, where there's lots of ready buyers. But that does put us fundamentally in a politically risky situation if a future Democratic president decided to block, all of the pipelines going across to the states. So I think that's a tail risk, but I think it's one of those things where it's, that would be a very expensive insurance policy at this stage to consume, entirely our own crude. So I think it's, when someone really focuses on the price of, because when you think about like how much we paid for imported crude, you know, that you had the number there, hundreds of billions of dollars in the last decade. You also have to balance that off of how much money we made, you know, quote unquote made by selling our crude at higher prices than we would have received on the East Coast to the U.S. Midwest market. So I think that's the big trade-off there. It's the same reason that many cases, you know, the United States would, you know, they would rather sell oil into Ontario and Quebec than supply that same oil to a refinery in Wisconsin. It's almost in every case, it just makes more, someone is making a profit by doing so. You would need some kind of, like in the United States, for instance, they did have a policy where they banned the export of crude oil. So it wasn't even a tariff. It was actually just an outright ban on the export of crude oil. But that distorted the market and created a whole bunch of kind of inefficient capital allocations. That because, you know, well, sure, so that decreased the cost of oil in the United States while keeping the rest of the market fine. So what people did was they just pocket the difference, and sure, they wouldn't sell crude oil, but then they'd build a refinery, and then they would refine the crude, and they'd sell the gasoline out, you know, to the global market. So it's all about these economic transformations and trade-offs. But I would say generally I am quite happy with our purchase of Saudi crude because it's made Canada richer overall.
Thanks for that. And you wouldn't think that Canada could have its own internal cost of oil and exports would be at a different rate, and, you know, rather have import tariffs on foreign oil? Is that not a possibility?
It all comes down to any policy that you made that would create some kind of economic penalty for what's currently happening. You know, based on your kind of classical economic theory, you're going to be dropping to some kind of suboptimal outcome. That overall, the aggregate wealth of Canadians would be lower in that scenario because you are, I think the best way to think about it is essentially an expensive insurance policy. As I was saying, I think there is an argument for why we should be more kind of protectionist or nationalistic with our oil. But I do think that argument needs to be balanced against the costs of implementing that. And in many cases, we're also talking about, you know, billions and billions and billions of dollars of lost kind of annual wealth for Canadians that, you know, someone would be paying for it somewhere. Someone would be paying for the insurance policy, and that would either mean higher prices at the pump or kind of lower realized prices for Canadian producers.
Okay, thank you so much.
Thank you, Jackie.
Thank you, Jackie. Any other questions, you guys?
I have a question, Rory. Thank you so much for your presentation. Very insightful. I'd just love to know if you have any opinions on the effect of automation in the energy sector. And when I say energy sector, I mean oil and gas and renewable resources. And I worked as a geophysicist, and in our community, we're already talking about like machine learning and, you know, applying automation techniques. Yep. So do you see the possibility of the reduction in technical roles in the future?
It's an interesting one. I would say yes and no. Classic. I would say that for technical roles, I actually think if the analytical demand is there in the firm, which I think in many of these companies it will remain, I would view things as like machine learning and other kind of, call them algorithmic enhancements. I mean, I use machine learning in the sense of stuff I do, and I view it more as a tool than as a kind of a competitor. I think it increases the productivity of the analysts you have on staff, where I do think you will have automation displacement is more at the actual field work level. The classic example of this are, you know, the massive, you know, dump trucks that are kind of bringing oil sands kind of ore back and forth. Those I almost guarantee over the next little while over the next couple of years you know, I think automation will become the rule. Anything that has a repetitive kind of physical element like that, I think, is at risk. You've seen it, and this is not just in oil either. This is mining. This is a whole bunch of kind of that same space. Anything that has a truck in particular, driving back and forth, very, very kind of a concern for automation. Whereas on the technical side, I would say that, you know, it's a little bit, it would be a little bit like fearing kind of the invention of Excel. Because I think it just increases the potential, kind of the analytical capacity of the people you have on staff. Now, sure, that could mean that, you know, 5 people can now do the job that 8 used to. But in my experience, the kind of familiarity with these tools is still quite weak, kind of across a lot of corporations. And I would expect more that the demand for, and as an example, I used to work at Scotia in a role where, you know, as things got more chaotic, the demands on me kind of increased exponentially to explain why I thought these things were happening. And I think when your capacity expands to the degree it would with a whole host of these, and not just, you know, not just machine learning, but I think the proliferation of open source packages for things that you used to have to be able to, you know, write kind of an economics PhD dissertation to code are now available in like 30 seconds to download. So I think the proliferation of that is going to make everyone more productive in that space. But I do think there's less potential upside there for, you know, someone that their role in the supply chain was driving a truck, whereas that truck can now be automated and it might be monitored by 1 or 2 analysts instead of 30 drivers. I think that for me is the bigger concern on the automation side right now. I don't think it's not just a risk. I think it's almost a certainty, because as I was saying, that if the sector can't grow much more, if the Alberta sector can't grow, you know, forever, it eventually needs to turn its sights on increasing profitability. And I was saying earlier that I think that the Alberta sector has a head start in this versus the shale sector in the States, because they've been in kind of, call it holding pattern mode for a little while when pipelines have been an issue, and they've really made good efforts at reducing costs. But a lot of that is, you know, first you go through your process optimization, right? And then you start to like try and figure out which components of, you know, which vendors you can lose, or which consultants, or which service companies, or what things you can bring in house. How you can try, you know, cut costs anywhere. And then after all of that, you start to whittle away the actual labor force of the company. I think that's one of those things that over time, I expect these companies to be still capital intensive, but increasingly less labor intensive. Now you compare that to say something like solar panels is a great example. And I'm not suggesting that, you know, an oil sands truck driver become a solar panel installation worker, but if you think about the things that are getting cheaper in solar panels are the manufacturing of solar panels. China's done an incredible job at essentially dumping, you know, cheap panels across the entire market. It's been very, very difficult to make money in the manufacturing side. But the area where costs have not decreased material, and in many cases actually have increased, are on the installation side, because you still need, you know, a person on a ladder in a harness up on your roof, kind of strapping stuff in. And I think that is, you know, we're nowhere near automating that type of work. And I think there's a lot more of that type of work in consumer-facing renewables than there ever could be on the oil side.
Thank you. Very interesting. Thank you.
Thank you.
Terrific. Thank you. Okay, we have time for maybe one more question.
Good morning, Rory. My name's Alan. Thanks so much for your presentation. Very informative. This is also a bit of a chin stroker on a few things that you've talked about, but I love the way that you see everything being connected. So I feel like this is an appropriate question for you.
Okay, I like that.
You made an interesting comment near the beginning of the presentation about that the oil industry drove wage inflation, which I totally agree with. As a major industry that drove wage inflation transitions to a phase of maximizing profitability, and against a backdrop of, you know, in general, our wages keeping up with inflation.
Yeah. How
does this wage, I don't know, stagnation potential end up impacting the greater economy?
So I think so the one thing I would say, and I'm going back to that last slide in my chart here, because I think that was the one I actually made special for this presentation, because I was just trying to kind of pull all of it together in one slide. I think the important thing here is there is actually a series that breaks out oil sector worker wages specifically. And I purposely actually didn't include those because I actually think those aren't as interesting as the overall wage rates. That even if oil was always a larger portion of Alberta GDP than it was of the employment base. It's just a relatively capital intensive business that relative to the amount of the tens of billions of dollars it costs to build a facility, you don't need that many people to run it. You still need lots. So it's definitely still a major jobs creator, but it is relatively more capital intensive. So what you saw there though, so it wasn't just the running of these facilities that caused that wage inflation. It was the fact that as you essentially ramped up on that left-hand chart, as you ramped up from spending billions and billions and billions of dollars, in the sector from very very little to a very very a tremendous amount. That didn't just go. So yes, oil sector workers make a lot more money than the average worker in Canada and the average worker in Alberta. So if you expand that worker base, that's going to put strain. That's going to put upward pressure on wages. I remember actually at the beginning of the 2000s, I read a report from the National Energy Board that talked about, and I read this a decade after it was published, in the middle of all this wage inflation, and it actually had talked about oil sands production break-even costs, $25 a barrel Canadian. So obviously we dramatically kind of outstripped that, and at certain points, it's always a bit of an art to kind of know which break-even you use, but break-even's 60, 70, $80 a barrel, and a lot of that was wage inflation and service cost inflation. Because it wasn't just that these companies were paying people; they were also paying people to build roads to their site. They were paying construction workers to build facilities. They were paying all of these people had huge spin-offs. They had a lot more money. They would, this is how you would get things like the labor market tightens so much, and you essentially had such a deficit of people that you had those Tim Hortons workers, making $25, $30 an hour. That fundamentally is an unsustainable process because eventually something has to give. Eventually you pull enough people from, a lot of people are coming from Atlantic Canada. A lot of my friends actually came, they graduated from Queens and went right out to the oil sands to employment. That pull was enormously attractive. But as the narrative changes, as people start to pull back their investment, the level of quarterly investment now is the lowest point that I can find on record since the 2000s began. And that means that all the money is being spent somewhere. This is the classic observation that someone's expenditure is always someone else's income. So when the oil sector cuts their investment budgets by 85% or more, all that entire labor chain, loosens up. And you no longer have that. You no longer have that kind of environment. So I'm realizing I may have kind of, as is typically my pattern here, I may have forgotten a little bit the final kind of crux of your question. But I do think if you look at the right-hand chart here, the point I've been trying to make is that if you don't have that uber tight labor market anymore, which Alberta no longer does, its unemployment rate is now higher than the national average. Wage rates are now actually, after outright contracting, they're now growing at a slower rate than the national average. Part of that is because the oil sector kind of growth is no longer there like it was in the mid-2010s, but also because the average wage in Alberta is so much higher than the average wage in Canada. That part of the challenge here is it's going to take years and years and years and years for the labor, absent another kind of renewed boost in oil sands funding, which I'm the first one to say never in the oil sector. It could happen, but I have a very very strong doubt that we're going to see any kind of investment like we did in the mid-2010s. So eventually, I think Alberta's wage gains are going to likely underperform the rest of the country for the foreseeable future, as the rest of the country catches up to basically the wages that are currently considered normal.
No, thanks. And how do you think that would sort of impact the broader Alberta economy? Like, because totally agree, totally with you, wage gain subdued. then that has to sort of filter out elsewhere, housing prices, etc.
Okay, I see what you're saying. So I think the on the housing prices and stuff, obviously, I think one of the housing has been a really bright spot in asset prices in the post-COVID period. That's not generally been the case in Alberta because it has had all of these kind of countervailing kind of headwinds with it. The classic example is that Calgary has way more commercial real estate than any kind of city of its relative size should have, and that made a lot of sense when you had the massive boom time. But now you're going to have likely kind of chronic low levels of capacity utilization in the commercial real estate space. Housing, I would assume, even if it's not a bear market in housing, I think in many cases, even if things don't get really bad in Alberta, I think the more likely outcome is that Alberta will increasingly miss out on some of the upswing that we will see in other provinces like BC or Ontario or Quebec. As those people that would have operated in the wage rates of Alberta, maybe they'll move to the greater Toronto area now. Not necessarily in Toronto because very expensive as well, but particularly with COVID and remote travel and stuff, all of a sudden the proximity of your labor force isn't as important as it once was. And at this moment, those potentially remote Alberta workers are expecting a higher wage than someone from a smaller city in Ontario would at this exact moment. That's because of years, a decade and a half of well above national average wage inflation. So it's you're either going to get kind of outright kind of wage contraction, which you did see in 2016 on that right hand chart for Alberta, but it's generally an abnormality. People don't typically accept kind of lower wages on a reliable basis. I think more likely what we're going to see is a kind of stagnation of wages that's going to underperform the rest of the country, which is then going to have, I constantly think that, Alberta will eventually come back to, and I think it happens all the time, but come back to the discussion of trying to maintain current spending levels at healthcare or education or whatever without the current tax rates. Lower tax rates in the rest of the country, no sales tax. I think these types of things are things that are going to come back because they're going to, that chart on royalties that, never really before have royalties been contributing less to the provincial coffers than they are today. So that's going to have to give somewhere as well.
Oh, cool. Thanks for your insight.
Thanks, Ellen.
Wonderful. Okay, any final last burning questions for Rory? I know we've kept you way longer than expected, but you've just been so engaging and so helpful. We can't seem to get enough of you, so we're probably going to have to have you back if you'll be so willing, Rory.
Always happy to. And also, if anyone, I spend way too much of my day on Twitter, Rory_Johnston, and a couple of you actually connected me ahead of this presentation on LinkedIn. Always happy to chat, happy to do bilateral calls and kind of just I'm probably even more candid on a bilateral basis than a conversation I know is being recorded, but hopefully I can chat with you all again soon. And if there are any other kind of final questions, I don't need to be anywhere for at least the next 15 minutes, so I'm happy to keep chatting.
Does anyone have any last minute questions?
Just one thing, Rory. Thanks for your presentation. It was very wonderful and very eye-opening for us, especially people who are professionals in Alberta oil and gas. I didn't catch the Twitter handle that you said, because it would be much better to contact you on Twitter.
Yeah, Twitter is always the easiest place to contact me. It's just my first name _ my last name.
Okay. Okay, just one question, just a quick one. We have been talking about hydrogen so long that hydrogen should be part of the energy mix, especially in Alberta. Are there any initiatives to take a step forward, like step further for hydrogen to be used in fuel cells? Are there any initiatives in Canada right now?
So I'd say a couple things. And one of the things is that, I agree. When I first got interested in energy, hydrogen fuel cell vehicles were the future, batteries weren't going to keep up. It was kind of like, I don't know if anyone remembers like mini disc players that were competing with, MP3 players back in the day. It just seemed, it seemed like a fundamentally better technology that just obviously ended up losing. I would say hydrogen kind of falls into a similar basket. I think that it's different. It's so fundamentally different than a lot of the other renewable technologies because it's a gas. It's fundamentally a commodity at the end of the day. It's something to be burned. It's essentially a chemical battery. So I'd say that I don't know of any concrete plans that we're going to, in the next 5 years turn into a global hydrogen superpower. But I do know that those proposals exist. I just don't know exactly where they are in the kind of policy execution stage. I would expect that we're going to see over the next year, we're going to see a lot of very interesting proposals for government support that will attempt to kind of jumpstart a whole bunch of these sectors. And again, it's always important to remember that government investment and government stimulus and government job creation often gets a bad name. But again, it's essential to remember that the oil sands would not exist without government cooperation, nor would fracking. So both of these things began as public-private partnerships and collaborations. And I think that it's very likely that the future, if any future commodity sector in something like hydrogen or lithium kind of exists one of the ones I thought was very cool is extracting lithium from tailings ponds and actually viewing the tailings ponds as not just a liability, but as a potential source of commodity extraction themselves. There's so many interesting things going on, and it's always hard to disentangle hype from kind of economic reality. But I would say at this exact stage, it doesn't look like any of that stuff is is ready to fully take on the mantle that oil and gas did. But I think combined, it will begin to kind of bridge the province and the country to that next kind of stage.
Thanks, Corey.
Perfect. Anybody else? All right. So Rory, I just wanted to thank you again. I think this has been absolutely remarkable. I know we've gone way over time, but as you can see, this is an extremely hot and much needed topic right now, especially for those whose lives have been impacted by such serious issues. So somebody just texted me and they said, this event has been 5-star. Over the years listening to these presentations, this ranks in the top 3 for me. So I just wanted to pass that on.
Thank you for that compliment, whoever sent that in. Thank you,
Michael
to
Stark.
yourself and to Higher Learning for hosting.
Higher Landing.
Oh, so sorry. Higher Landing. I apologize. Higher Landing. I'm looking at it right in front of me too. But thank you to Higher Landings for this opportunity, and I'm very, very happy to chat with anyone bilateral offline, and I am very much hope to kind of be back with you again in the future.
Wonderful.